Hello, and thank you for coming back to the Win-Win Investor channel. We are very excited today to have as our guest a gentleman that needs no introduction in my world, but maybe a little bit less known to your general public. After the mortgage meltdown of 2008, Jon Daurio was a regular guest on financial market television shows for networks such as Fox Business News, CNBC, etc. He was the founder of Kondaur Capital Corporation, where he served as chairman and CEO from 2007 to 2011. Kondaur is known for being an 800-pound gorilla in the mortgage servicing and distressed debt arena. And it was largely due to the innovations that Jon put forth in creating this company that made them so. Where when I met Jon back in 2008, the Kondaur Capital was a 25-person company, and by the time he left the organization, what did you have, about 500, Jon?
Yeah, just north of 500.
Welcome to the show, Jon.
Thank you very much. Glad to be here, Phil.
So we're going to jump into some questions. You founded Kondaur Capital in 2007. It was a whole year and a half, really, before the proverbial shit hit the fan, so to speak. And many secondary mortgage market investors were still believers in new originations and unwilling to really acknowledge the writing on the wall. Take us back to 2007. Tell us some of the signs that you were seeing and what caused you to jump out of origination and into distressed debt servicing, starting a fund, and then starting Kondaur.
Sure. The primary event that happened was basically New Century declaring bankruptcy in February of 2007. To me, that was a sign that the pending financial crisis was coming. Also, for any of your viewers that have seen or read the book The Big Short or seen the movie, that conference, which was ABS West, the securitization conference, I was actually in the audience when that question was asked about all of the derivatives and what happens if there's just even the slightest uptick in defaults. So it was a combination of those two things that led me to actually go back to a business model that I had started when I started a company called Park Place Capital in 2001. That entity was a retail mortgage origination entity in which I received servicing. It was a servicing company, but basically entities that originated problem loans would transfer me to servicing with the idea that I could refinance them. A lot of those loans were compliance issues, and a refinance of a compliance issue is a way to eliminate the compliance issue. But I also got some experience in having servicing transferred to me of non-performing loans. So I got the idea when New Century declared bankruptcy, and then actually in the summer of 2007 was when John Contoulis, the con in Kondaur, I'm the door obviously, got together and we formed Kondaur Capital LLC, which was the predecessor in interest to Kondaur Capital. As things started to get worse, I was able to successfully raise $8 million. It was $5 million of initial capital and then another $3 million from a private equity fund called JAM based in New York City. And in August of 2007 is when we first bought our first pool of loans. Being a smaller investor, you can appreciate this. We bought, it was $1 million purchase price. My recollection was it was 15 or 16 loans. Mm-hmm. But by November, we had liquidated all the loans and it grossed about $2 million. So we had a 100% return on that relatively small investment. And that's what led me to raise a tremendous amount of more capital in November of 2008. The idea also was that I saw that the servicers, especially the large bank servicers from whom I bought most of my loans in those early years, Citibank, Wells Fargo, Bank of America. I realized that the way they serviced the loans was just improper, especially for the magnitude of what we saw coming. Many of those asset managers were managing well over 1,000 assets per person, which makes it impossible for them to really get personally involved in each asset. I was the one that, when I started Kondaur, limited the number of assets per asset manager. The target was about 50 per asset manager. Our better asset managers might have upwards of 100, and some asset managers would have fewer. But in that way, they would be able to really be personally involved, and also to be able to set up net present values for each liquidation strategy. Another liquidation strategy that was really not being used was the deed in lieu of foreclosure. Entities like Bank of America had what I considered arbitrary caps on the amount of money that can be paid to a non-performing borrower for the keys to the house, for the deed in lieu, and also for another expense, as we all know in the business, getting the borrower out of the house.
Right.
So we would just do net present value calculations of, well, what it would be if we actually foreclosed, what would it be if we modified the loan. Quick tangent, we modified less than 1% of our loans. Actually, I believe it was less than 0.5% of our loans. And that was because so many of those loans were really made to people that really couldn't afford the houses they were in. But we tried to take a much more personal approach.
Yes, that's and that actually was a question I'll jump into now. One of the revolutionary techniques, as you speak of, less assets per asset manager, but then you also utilize boots on the ground. You reached out and trained thousands of real estate brokers, your asset managers did, to go out and make contact with borrowers, knock on doors, and really kind of help the loss mitigation process along. Tell us about that, and why'd you come up? I guess it goes all in hand with the inefficiencies of mortgage servicing at the time, right?
Sure. Another inefficiency of mortgage servicing at that time, and it's coupled with mortgage servicing, but even loan sales. Back in those days, when a large pool of loans were being sold, the owner of the loans, not the servicer, but the owner, would put out a request for proposal, so for bids.
Right.
People would give an overall bid. So if it was 1,000 loans, somebody would say, okay, for the 1,000 loans, I'll pay $100 million. And then they would receive all sorts of bids. Then after they decided who the winning bidder was, people would go in and perform the due diligence review. Now, also in my background, I'm an attorney. I was a compliance attorney for many years. I knew that there was a big problem with respect to the chain of title to the loan. Not chain of title to the house, but chain of title to the loan, meaning people weren't diligent recording the assignments of the mortgages. So one of the things that we did that was unique at Kondaur was, not only did, when we gave bidding, we gave loan level bidding that would be held. So in other words, on that hypothetical 1,000 loan pool, I would give 1,000 prices, and I would hold my price for 30 days.
Wow.
The idea was, until I could become the stalking horse, or the, as you call it, the 800-pound gorilla in the industry, I could only get what I could get. And so what I figured is, they had relationships with people like Bayview or Greenthal or Easton Savings Bank, etc. Those guys would win the bid, but then they would know exactly what I would pay for the fallout. And that was another inefficiency. Because they did the compliance review post-bid, every buyer would say, okay, well, I'm going to kick out these 95 loans. Mm-hmm. And of course, they would state that those were the best 95 loans, so they would revise their bid downward. And that's where I felt that my loan level bidding, where I held the bid, gave the seller some more power to be able to negotiate with whoever the winning bidder was, so that they could maximize, because they always knew what I would pay for what was left over.
Right.
Very good part. Now, in order to be able to come up with loan level bids, and this gets to your question, you got to remember, back in 07, 08, 09, we were in a diving home price market.
Right.
There really wasn't much expertise on predicting what home prices would be at any point in time. And a mantra of Kondaur that I'd set up was velocity, that we really needed to get out of each asset as quickly as possible. And if we decided to take a longer path like foreclosure, like I said, we would do a net present value calculation in which we would really try to estimate what a home would be worth, which is difficult. But to try to figure out what the home is worth, when these loans were being sold, A, the servicing notes were typically awful, so you really didn't have a good idea of what situation the borrower was in. And B, you were forbidden from going in the house. And so you had to, in essence, guess what the amount of deferred maintenance was within the house when you were making your bidding. We got the idea and said, hey, it would be great if we used the boots on the ground, especially at that time when realtors were desperate for any type of business because their industry was really hurt at that time.
Right.
We said, let's get them. They could knock on the door. A, they would confirm that the borrower actually is living in the house, which was a significant percentage, somewhere in the single digits of loans that we bought where the borrower was very difficult to locate or the existing servicer didn't have it. And B, that realtor was able to get in the house and basically tell me what the inside of the house looked like.
Right.
And so that was very, very, very helpful. And then what we also would do is we would ask brokers for a broker price opinion, a BPO. Traditionally, you paid for BPOs, but at that time, we found that brokers were more than willing to give us the broker price opinions to be in a pool of brokers that we would then eventually choose to list the house once we got possession and ownership to sell it. And so with the brokers, what we felt, and I apologize in advance, we felt that brokers were fantastic at figuring out what were the comparable sales and listings,
right.
But they really weren't as well trained as appraisers, for example, to be able to figure out what type of adjustments should be made for our particular subject property. You know, an example, if the house next door or whatever the comp is, has a swimming pool and yours doesn't, what really is the market adjustment? Because as we all know, that's one of the worst things from an investment point of view, to put in a pool in your home. You never really get back what you put in when you invest in the pool. And so that's where we found that by employing that strategy of utilizing brokers across the country, we quickly developed a competitive advantage to everybody else out there that was bidding on loans. Because a lot of my competition, like Bayview at that time, were just institutionalized, if I could put it that way.
Right.
They weren't really getting down into individual assets and managing those assets, if I could put it, with a human touch.
Right.
And that was another thing. Is we found that, I see in the background your book, The Win-Win, and we felt it was a win-win situation where, especially in a deed in lieu, because when we got the brokers to give us their comparable sales and listings, we often utilized the brokers to find rental properties or apartments that we would then, when we would present to the borrower a proposal for a deed in lieu, then we would also be able to propose, and hey, by the way, here are 3 different properties that you could move into to rent, after calculating, because we would always underwrite every borrower that we got to see if we could modify them,
right.
And if the modification made sense. But like I told you, the vast majority of the time it didn't.
Right.
Also, utilizing brokers, many times we even utilize the broker to deliver the deed in lieu to the borrower, the cash, the deed in lieu cash, and affect that transaction. And that also was very effective. It really personalized it. And we found that the borrowers who basically, were freaked out, right? They had a strong suspicion that they were going to lose their home.
Right.
They saw that their equity would, many times was completely wiped out. And to have that more human touch of a local realtor actually deliver them the cash just gave it a much more of a win-win situation.
Right, and that's in you. I think you referred to it as SPOC, the single point of contact. One of the things that I've experienced is in frustration in meeting borrowers is that they have to call up an 800 number. They're talking to a debt collector. That debt collector has no authority. It's very rare they can speak to an asset manager directly. And you really streamline that, and by bringing in a local broker along with an asset manager who didn't have a ton of files and was the single point of contact, that personalization really, I think, elevated your status when you communicated with borrowers, correct?
Yeah, and again, and forgive my arrogance, but we were really the first ones to introduce the single point of contact, or SPOC. And again, that was critical because we perceived and knew that that borrower needed to be able to talk to somebody that had the authority to be able to make decisions, that didn't continue to put them off, which was typically the experience that they had with whoever was servicing the loan previously.
Right.
And in fact, we found that so many of our borrowers were so grateful that they were talking to a single point of contact that could make decisions. I can't tell you how many times when we, in essence, kicked the person out of their house, right? Because we kicked them for deed and foreclosure, we got baked cookies, we got cakes, things sent to us where people were just so grateful that how we dealt with them.
Right.
I think that was another reason for the success of Kondaur.
Yeah, I've had that personal experience myself. I've walked in to mediations having a borrower not even willing to shake my hand, and now I still get Christmas cards from them. When you reignite that level of integrity, where you reestablish a relationship, you take over as a single point of contact, and you treat them with dignity, knowing that so many millions of Americans were really wrapped up in this. It really did revolutionize the market. The other thing that you did, that Kondaur did, that really revolutionized the NPL space, it took what has been traditionally a good old boys network of secondary loan market traders, and you tapped into that through your connections. But then one of your strategies was to buy these pools of dozens or hundreds or even thousands of non-performing loans. And one of the exit strategies was then to turn around and offer those loans to less sophisticated real estate investors on a single loan basis. Tell us what prompted that, what were some of the pitfalls, and what were the benefits that you saw in really opening the secondary mortgage market up to individual investors?
Sure. The idea came from the net present value calculations of each exit strategy. So one exit strategy, which was unused, but was to resell the loans. But as you said, we were the first, and for a long time, the only entity that was like, well, why don't we resell the loans to an individual investor? And that was yet another area where we used the local real estate broker, was to help identify local real estate investors. And it also came from a sense of one of the things I remember, it was one of the few plots of land that we had bought. It was a non-performing loan that was secured by a plot of land in Florida that was on the coast. And we resolved it by selling the loan actually to the adjoining landowner. We contacted them, and we figured they probably have a better appreciation for what really that property is worth, rather than me based here in California. Even though I was using local brokers, I felt like the adjacent landowner would really know. So that prompted the idea of, well, probably local real estate investors might have an advantage and know better what that property is really worth than we would. And so we would just do net present value calculations, and if the bid that came in from that individual investor was greater, we sold it. An interesting story, if I may just tell you, is I made it a point that anybody that wanted to talk to me as the chairman and CEO, they could. I liked it to go through the chain of command to see if it was something that could be resolved. But if somebody insisted, I always said, I have no problem in talking to people about our company with any issues they may have. So I had one real estate investor that wanted to buy a group of loans rather than individual loans. And at the time I said, look, I'm not going to group them. I said, I have no problem selling you multiple loans, got to get individual bids on each loan. And
Right.
as I did when I bought the loans, I would say, okay, well, I'll sell you these or I won't sell you those.
Right.
But in talking with him, I told him, I said, and by the way, I think you're making a mistake. And, I could figuratively see him step back on the phone. He's like,
Right.
well, why? I said, well, because I think I am the biggest and baddest. I think that I'm best at figuring out, what it costs to evict the borrower, what it costs to rehab a property, what it costs to list it and sell it. So, unless you've got some advantage that I don't have, you're probably overpaying for the loan. And this particular investor said, well, yes, I actually own a construction company. So, and the things that attract me to particular properties is I know they have a ton of deferred maintenance and some issues that require reconstruction. And he said, I bet I could do that cheaper than you can, which is why my bid is better. And that's really what cemented the idea of, hey, we've got to make sure every time we assign these loans to our asset managers that the asset managers obtain bids from individual investors. And that was typically because we knew the bids that were going to come from the, as you call it, the good old boys network. A, because it was such a small pool, and B, they don't have any of those competitive advantages.
Right.
It really would be unlikely that we would sell the loan to them. But
Right.
It turned out to be actually a great strategy. We sold, it depended on which period it was, 07 to 09, 09 to 011. But by 09 to 011, we sold probably about 15% of our loans, which was fantastic because
Right.
when I talked earlier about the mantra of speed,
Yeah.
that was, we bought the loan. Typically, it took about 30 days for the servicing to be transferred. During that period, we were out pitching the loan. And by that day that the servicing was transferred, we typically sold it.
Right.
So when you think about in terms of returns to your investor, that's why we were able to generate tremendous returns and able to raise so much money, was because of our speed. That's another thing that gave us a competitive advantage, is that, even though, in some situations, I said we made 100%, but even if we made 5%, because we did it within a 30-day period, it gave us, an unbelievable return. The critical part, which is what we were able to develop, is the ability to replace that loan very quickly
Right.
with another loan. But like I say, by 09, we really were the 800-pound gorilla. And at that time, we were really fortunate that many loan owners were coming to us to see, hey, will you give us a bid on these loans?
Right.
Also, because, like I said, we got them on the candy, so to speak, of these individual loan prices.
Right, right. And one of the lessons I learned from watching you guys do that was you talk about net present valuation. If you can identify a tail right up front, then being able to exit that as a loan sale, take a small return, get it done quick, as opposed to, dragging it out. I mean, I see Bayview loans that they've owned for 6 or 7 years now, and they're still, and they've spent so much money, it's a big loss that they don't even want to take at this point. And they're just trying to pull the wool over some innocent buyer on the back end. One of the things that I think you were famous for, I remember some of your employees saying, was that you never thought that there was such a thing. There was a lot of talk about bad mortgages back then. And what was you saying? There's no such thing as a bad mortgage.
No bad loan.
Right.
Bad loan pricing.
Exactly. That's great. I love that line. So in 2011, you basically took an early retirement. Congratulations. The Kondaur Capital Corporation lives on, albeit more in a specialty servicer kind of situation rather than as a fund investor, the way that when you were running it. A lot of your competitors have come and gone in this business. There's a lot of folks that came into it just in the last few years. Neuberger Berman spent $1 billion 3 years ago. Baalbek via PRP spent $1 billion in the last few years. What do you think about the NPL business today? Whether it's from an institutional perspective or from an individual investor perspective, can we still make money in it? Is there room for new business? What do you think of the business as it stands today?
In short, yes, I think you can still make money in the MPL business, and I think there are room for new investors, but it is exponentially more difficult than when I did it. And one of the reasons why I never re-entered into the NPL business. In '07, when I started Kondaur, I had the idea. In fact, I wrote an article for asset securitization in January of 2008, in which I shockingly correctly predicted that we would reach the trough or the bottom of the trough of the real estate market around, right around the end of 2010, 2011, which, by the way, coincides with when I retired, because I saw that at that point, the advantage for me was with housing prices dropping and continuing to drop. That was another thing that was a barrier to entry. There were very many or very few investors that were willing to assume the risk of buying into a non-performing loan without really knowing when that trough was going to hit. So that was one thing that today you have home price appreciation. And as a result, I believe as a result, the market has unbelievably matured. So in other words, when somebody's putting a loan out to bid, it wasn't like when I first started that there were very few people who had actual liquidity or cash to be able to buy a pool of loans, let alone a large pool of loans. Today there is. And today, and I'd like to take credit for it as you've attributed to me, there's a vibrant market of these sellers selling individual loans, right? There are so many electronic marketplaces or auction sites to buy these particular loans that you can go in and buy a single loan. And so I believe there's an opportunity, again, if you've got an economic advantage, if you're like that guy that I spoke to that owned a construction company.
Right.
So that if you're buying the loan, you have a much lower cost at rehabbing the property. Or if you're a realtor, you have a much lower cost of being able to eventually sell the property.
Right.
But I don't think personally that there is an opportunity for another Kondaur. I think it would be very difficult for somebody to enter the market today and to be able to buy thousands upon thousands of loans and to be able to liquidate them within a 6-month period, which was the average liquidation time I enjoyed during that '07 to 2011 period.
Right.
In addition, as you mentioned, a lot of it's very, very, very difficult to manage the tail. So, in other words, if you are buying, sorry about that, I thought I had the phone off. If you're buying a pool of loans, let's say 100 loans, you might, again, so many investors that went out of business doing this is they'll buy 100 loans in a pool. They'll make a ridiculous return on the first 10.
Right.
They'll be able to make a decent return on the next 40. Maybe on the next 20, they're getting, low single-digit return, and then they get killed on the tail.
Right.
And that's where I think that if you are a smaller investor, so that if you're buying, 3 loans, you don't really have a tail, right? I mean, in theory, you sell the first 2 and then the third, but you're only buying 3 loans where you've done that, as you mentioned. The tail meaning what already your exit strategy is. You have it in place unless something unforeseen happens.
Right.
But I think the NPL game for a larger investor is much, much more difficult.
Right, and that absolutely makes sense. I see that as well. If you're small time, you're buying locally. You see these investment groups where they're buying reperforming loans into their 401k or their self-directed IRA. That's kind of where the business really is. But I worry about the Neuberger Bermans of the world.
Yeah, it's again. I think it all comes down to the servicing as well as their I'll call it variation analysis. One blip in the economy and how is it going to have? How is it going to affect them in a period where? And again, I don't know what their business model is, but if they're assuming home price appreciation, what happens if they're in that particular market where the home prices just start taking a dive. And as I know, with the Port St. Lucie
Right.
example, where Kondaur at one point we owned, I believe it was 183 non-performing loans in Port St. Lucie, which was at that time for the size of Port St. Lucie, we were basically defining what the market was for homes at that point. Because if we had liquidated, remember, I was trying to get them liquidated in 6 months. If we liquidated even half, 90 of those houses in a 6-month period, our pricing were all the comps.
Right.
That going forward. So the same thing happens is that if if these other companies have a concentration in an area, and again, what I've heard third hand is that a lot of these entities are not buying as I did, where every loan, like I said, no loan, no bad loan, only bad loan pricing. So I would give a price no matter where the loan was. I didn't care what jurisdiction it was in. I didn't care if it was a $5 million loan or a $50,000 loan. I priced accordingly. A lot of today's investors have certain investment parameters that I think actually increase their risk in case something happens. If everything remains stable, it's a great model.
Right.
But if something happens, I'm a little concerned.
Well, that's interesting, man. That really is my next question. I mean, here we are just over a decade after the crisis. Markets we know are cyclical. Many have already predicted that we're at the top of the market, that we're due for some kind of reset, maybe not in residential real estate as much as some other area of the marketplace. Tell us what your view is. I mean, you obviously were a forward thinker in 2007. Where do you see the market, whether in real estate, mortgages, or just the financial markets in general, where we stand? And then what are you working on as a result of that?
Sure. I believe that a financial crisis as we saw in '08 is not happening anytime soon. I believe that we still have in many markets home price appreciation, although the magnitude has lessened.
Mm-hmm.
And I even see out here, I'm based in California, some local markets where there already is some slight home price depreciation. But I think that that's also a function of supply, just basic economics. Because some homes are taking a little bit longer to sell, I think that's leading to some home price depreciation. And part of that deals with basic affordability. Look at how much homes have appreciated over the last 10 years. And you get to the point where the population of prospective home buyers are really having a challenge with affordability. And as interest rates continue to rise, I think that's another thing that's going to put the brakes on the home price appreciation that we've seen. But I don't necessarily believe that there's going to be any sort of significant home price depreciation, with one caveat. Just like in Las Vegas or in Miami or things like that, where we saw those pockets had much worse home price depreciation during the crisis. There are certain areas where you might have, maybe a 10% correction in the price, opposed to something that's single digit. As a result, that's why today I am now put together a business plan, and what I intend to do is to originate loans again. And I believe, and based on my estimation, is that there are about 1 million to 3 million homeowners that are unable to get an owner-occupied loan because of their credit score. And I would say 1 million of those borrowers, I would say, have a sub 580 FICO, but they have at least 40% equity in their home, and they're likely carrying at least $50,000 of consumer credit. So credit cards or these personal loans, unsecured loans that people get. And so, as opposed to just a purchase money loan, I believe that it's a real opportunity for a debt consolidation loan that even though I believe the weighted average coupon or the weighted average interest rate on the loans that I'll be making will probably be in the high 8% range, and we're probably refinancing people out of a 4% mortgage that they might have gotten previously, their overall monthly payment will drop significantly, which hopefully will provide them the liquidity to be able to not be late on payments anymore, not take out more consumer debt, and thereby increase their credit score. Because as I think hopefully many of your viewers know, it is sometimes a 100 to 150 point hit on your credit just for carrying consumer debt, especially if that consumer debt is highly utilized. For example, if they have a $10,000 limit on their credit card and they're carrying $9,500 of a balance on it,
Right.
that's a very, very big hit on your credit. Plus, if they've got 10 credit cards where they have even less utilization but still over 50% on it, that's a big hit. So you can have a borrower or a homeowner that has never missed a payment on a mortgage, has never missed a payment on a credit card, and still has a sub 680 FICO, maybe even a sub 620 FICO. Throw in there one late payment, or God forbid a collection on a credit card account, they're below 580.
Wow.
And ever since the passage of the Dodd-Frank Act in during the crisis and the creation of the CFPB to create regulations with respect to the Dodd-Frank's ability to repay issues, as probably most of us know, on an owner-occupied property, the lender cannot make a loan unless the lender has a reasonable and prudent belief that the borrower can make the payments based on 2 years' worth of third-party documentation. That has scared many lenders from entering this market. In fact, the non-QM, non-qualified mortgage market, which is really the people that are making loans that aren't being sold to the agency. So, back in the day, what we called subprime loans,
right,
or even earlier with my gray hair, the B and C business.
Right.
Those loans today, if you look at what's been securitized, the weighted average FICO is well over 700. And if you look at even just the sheer volume of what's been securitized, I would say probably a total of $5 billion. When you've got a $1 trillion mortgage market annually, and you've got $5 billion that have been securitized since 2014, you can see that it's really an untapped market. So I believe that that's where there's an opportunity, and I believe, like win-win, that it's a way that we could really do something good for these homeowners that have done the right thing, have had the ability to develop equity in their home, but they can't tap it.
Right.
I hope that we don't have a situation where it's like Texas, where the only way, because refinances are in essence outlawed, the only way somebody can tap into their equity is to sell the home. And a lot of people, as we know, being in the real estate business, don't want to sell their home. It's something that they've become very comfortable with, and they really shouldn't have to.
Right. That sounds very, very interesting. So the win-win aspect of it is, and it amazes me that somebody could really be a good borrower making payments regularly, even if they're carrying 5 credit cards and a mortgage and 2 car payments, and their score is really low. And I've seen it firsthand where this is a person that's making a regular payment, but the way the credit rating agencies do their scoring just really kind of has knocked them out of the running. So the win-win there is you take somebody that has 60,000 of credit card debt that they're paying 20% on, and you now roll that into your mortgage at, even if it is at 8%, higher than today's standards. That seems like something that I would take if I were in that position. I'd actually like to ask you more about that. If we could take a little break, we'll come back with Jon Daurio and talk a little bit more about his origination business.
Thank you very much.